Hello and welcome to the channel. If you're new to my channel, do consider subscribing. Also turn the notification bell beside it so you get notified anytime I upload a new video. So in this video, I'm going to explain one of my personal trading strategies for synthetic indices, and I use this strategy to trade almost every day. It is a hedging trading strategy for synthetic indices. I'll break this video into 5 parts for better understanding. The first part, I'll give you an introduction to hedging, both theoretically and practically. That way you really understand what hedging is all about. Second one, I'll give you a list of synthetic indices that works with this hedging strategy. Remember, this strategy does not work for all synthetic assets. So I'll give you a list of synthetic assets that you should apply this strategy on. I'll also give you reasons why you should not hedge any other synthetic asset except the one I mentioned on this video. And the third one, I'll give you a list of synthetic assets that you can trade if your trading capital is below $100 or $100. The fourth thing I'll talk about on this video is the market condition this strategy works best on. Market condition you should avoid if you're using this hedging strategy for synthetic indices. And finally, the fifth one I'll talk about on this video is I'll go into a live trade and apply this strategy and actually show you how you can make profit using this hedging trading strategy for synthetic indices. So now let me quickly dive into step 1. Hedging in forex or forex derivative is a practice of strategically opening new positions in opposite direction to your previous positions. So let's go to the chart to explain what I actually mean by hedging. Let me quickly give you a practical explanation of what hedging is all about. When you first open a position and that position is going against you, you open another position in the opposite direction of your first trade. For example, if you open a buy position and the market is going against you, then you open a sell position with a higher lot size. That is what it simply means. Let me just give you a practical example. This is volatility 25 index. So I'll open a position here using a lot size of 0.05 and market execution. So I'll open a buy position. Assuming this position I opened is going against me, meaning that somewhere here I'll be incurring losses. Maybe the losses is increasing. So hedging is when I open in another position in opposite direction and with a higher lot size. Remember, this is the buy position I open. So if I want to hedge this trade, I'll open a sell position with a higher lot size, maybe a lot size of 0.010. So that is what hedging is all about. If the first position is going in your favor, you have no reason to hedge. What you just need to do is you set your take profit and you close your trade on profit. But if it goes against you, that's when you need to hedge. Remember, hedging strategy, not all brokers allow hedging strategy. There are some brokers you apply this strategy on, they will block your account or might not even authorize your withdrawal request. Before you apply this strategy on any broker, do check if that broker accepts hedging. If the broker does not accept hedging and you apply this strategy, you might not be able to withdraw your profit or your account might even be blocked. So now you understand what hedging is all about, how it works, how it's applied. Now let me tell you a list of assets that best suits this strategy. So let me show you the 5 best synthetic assets that you can apply this strategy on. So this strategy works on other synthetic indices, but I will tell you why this 5 asset is the best for this strategy. So let me go to the quote section of this MetaTrader 5 platform. So the quote section, so that I'll show you the assets. So this is the quote. I'll just click on this quote button right here. So I'll click on it. So the first asset that this strategy works best on is volatility 75 1S index. Remember, it's not volatility 75 index, it is volatility 75 1S index. It must have this 1S attached to it. So then the second asset is this volatility 51s index, it must have this 51s attached to it. Then the third asset is volatility 10 1s index, and the fourth asset is volatility 25 1s index, and the fifth asset, which happens to be the last asset, is volatility 100 1s index. So these are the 5 volatility synthetic assets that best work with this strategy. So you might ask me, why these assets, why not other synthetic assets? The reason is that these 5 volatility assets that I just mentioned has the lowest margin. When I say the lowest margin, what I simply mean is you require less than $1 to open a position with the lowest available lot size on these assets. Any asset that has low margin, then this hedging strategy can actually work for it. And if maybe when you check your quotes and you don't see these assets, what you just need to do is you just click on this add button there and add all those assets to it. When you click on the add button, you see volatility index listed among these jump indices. So what you just do is you click on the volatility index, and then you see other indices. Then you need to just click on them once. Once you click on them once, automatically it will be added to your quote page. So you can open any of the assets from here. So you click on charts. So now let me give you a list of the synthetic assets you should apply this strategy on if your trading account is $100 or less. If your trading capital is $100 or less, it's only 2 assets you should trade. One is the volatility 10-1s index, and the second one is volatility 75-1s index. Then the fourth thing is the market conditions that this strategy work best on. Anytime any of those assets I mentioned earlier displays these certain market conditions, you are good to go. And when the market conditions start changing, you already know what to do. You exit the market. Let's go to the chart for better explanation. So the best market condition you should apply this strategy on is non-volatile trending market condition. The non-volatile trending market condition is what you see on your screen. It doesn't make visible higher highs and higher lows, or lower highs and lower lows. It can either be an upward trend or a downward trend. So it can be a non-volatile upward trend or a non-volatile downward trend. This is one of the best markets that work best with this strategy. This is one of the market conditions you should watch out for when you want to apply this strategy. So the second market condition that works with this strategy is the volatile trending market condition. What you see on your screen is an example of a volatile trending market condition. A volatile trending market condition always make visible higher highs and higher lows, or lower highs or lower lows. So if you look at this, you see that it's making an upward trend. It's making an upward trend. In the process of making an upward trend, these are higher highs and higher lows. It can either be a volatile upward trending market condition or a volatile downward trending market condition. So any of this is okay. Then the market condition you should avoid by all means is the ranging market condition. This is an example of a ranging market condition. It doesn't make any visible trend. Once you see this type of market condition, avoid opening any position. Just wait till the market start trending, or look for an asset that is trending. So let me apply this strategy on live trade. Let me show you how you can make money using this strategy. So before I start the live trade, there's something you need to know. I need to tell you a very important part of this strategy. I need to tell you how to actually apply this strategy on the 2 market conditions I mentioned earlier. So one thing you need to understand about this strategy is that the way you hedge a non-volatile market is different from the way you hedge a volatile market. So let me give you a breakdown on how I'm going to apply this strategy. Let me start with a non-volatile market. For a non-volatile market, let's assume this is the trend. The trend goes like this. It doesn't make visible higher highs or higher lows. So this is the trend. First, we are going to enter our first trade, maybe somewhere here. because it's an upward trend, definitely we are going to buy. If the trend continues, then there's no need to hedge. We just set our take profit and close the trade on profit. But if peradventure we sold at this level and the trend keeps going up, which is against our prediction. For a non-volatile market, if you are going to hedge, this is how we're going to hedge. If the lot size used to enter this market is 0.2, we are going to hedge somewhere here, and hedging is you open a buy position here. So, and the lot size we use to open this buy position is 3 times the initial lot size that we use, which is this. So it's going to be 0.6 if you multiply the initial lot size here by 3. So we are going to hedge this trade with a lot size of 0.6. So we'll just enter it once, and once it keeps going up, then the profit we incurred from this 0.6 lot size will cancel out the loss we incurred here. So then we can close the trade on profit. Then for a volatile market, the way we apply hedging is quite different from what I just explained. Now let me show you how to apply hedging on a volatile market. This is a volatile market. It makes reasonable higher highs and higher lows. So it goes like this. This is a high here, this is a higher high, this is a higher high, this is a low here, this is a higher low, this is a higher low. So assuming we open a position at this level, maybe we opened a sell. You open the sell position at this level. Initially it was going according to our analysis, and later it reversed. Normally a volatile market, that is how it behaves. It reverses and gets to this point. At this point it's already giving us losses, so we decide to hedge at this point. Hedging here means opening a buy position. So assuming we open the first position with a lot size of 0.2, to hedge a volatile market you need to multiply the initial lot size by 3, which is 0.6. But because it's a volatile market, we are not just going to open the second position with a complete lot size of 0.6. We are going to hedge this trade, the first trade, into 2 places. We are going to divide the lot size into 2. First, we'll hedge with 0.4, and second, we'll hedge with 0.2. And how do you apply it? First, at this level where we hedge, you're going to open a buy position with a lot size of 0.4. Then definitely, because it's a volatile market, definitely it must retrace and still continue the trend. So you allow the trend to fall down a little bit. So once it falls below the level where you hedged the trade, maybe somewhere here, you open another buy position with the second lot size, 0.2 lot size. That way, when it reverses somewhere here, immediately it moves above the level where you initially hedged the trade, it will start giving you profit. This is the way you hedge on a volatile market condition. When I start trading live, this is exactly how I'm going to trade, and this is how this strategy works. First thing you need to do is to identify the market condition of that particular asset. Then you trade based on what I just explained now. So let me go live and start trading. I want to take a trade now, and I'll be trading volatility 10S index, as you can see here, and this is the 1 minute time frame. And why I choose volatility 10 index is because my trading balance is $50. So my balance and equity is $50. I'll go back to the chart. So I'm going to place this trade using my smartphone, and if you look, you see that this is the landscape view of the phone version of the MetaTrader 5 platform. If you want to switch from portrait mode to landscape mode, and this is the portrait mode, this is how it looks like, and this is the landscape mode. To analyze the market condition of any particular asset using your smartphone, you need to activate to the landscape mode. And to activate the landscape mode is quite simple. What you just need to do is, when you're on the portrait mode, as you can see on your screen, just scroll down your phone, you see auto rotate. Just activate auto rotate, then flip your phone, and you see that the chart will start showing you a landscape view. So the first thing you need to do, since I'm trading with $50, which is less than $100, I mentioned it earlier that if your trading balance is less than $100, you need to trade only two assets: volatility 10-1s index and volatility 75-1s index. So this is volatility 10-1s index. So the first thing you need to do is to establish the market condition of that particular asset. So, and you can only establish the market condition of this particular asset using the 5 minutes time frame. Currently we are on the 1 minute time frame, so I'll switch over to the 5 minutes time frame. So I've changed to the 5 minutes time frame. The 5 minute time frame will give you a broader understanding of the market condition of this particular asset. If you look at it, you see that it's making a non-volatile upward trend. This is a non-volatile upward trend. So somewhere here it was a little bit volatile, so that's the past. Here it made a non-volatile upward trend. Here it made a non-volatile downward trend. Because it's making a non-volatile upward trend, we are going to buy. Remember, you need to follow the trend. On the 5 minutes time frame, I've already established that this is a non-volatile upward trend. So I'll go back to the 1 minute time frame to calculate my entry. So I'll go back to 1 minute time frame. I'll click on this 1 minute time frame right here. So once I click, I'll switch over to the 1 minute time frame. So what I'm going to do right now is to open a buy position. So remember, for volatility 10-1s index, the minimum lot size is 0.20. So I'm going to use the minimum lot. I'm going to start my first trade with the minimum lot size. Always start your first trade with the minimum lot size, especially if your account is less than $100. So I'll just go ahead and click on the buy button to open the buy position. So currently the trade is running, and if the loss continues, I'm going to hedge. How to calculate where to hedge is what I'm going to do right now. So I'll just go back to the chart. So I'm back to the chart. So on the chart now, this is you see that you notice that here there was very little, there was no volatility from here to here. So if you notice, currently is exhibiting a little volatility currently. So I'm going to work with it. If the trend breaks below this level, this last support level, if it breaks this support level, that is when I'm going to hedge the trade. So if this trade keeps giving me profit, no need to hedge. I'll just set my take profit and close the trade on profit. So I'll continue with this video if it's time to either close it on profit or hedge the trade. So I'm back to the trade after a few minutes. If you look closely, you see that the chart went as calculated. I'll close this trade at this point and open another one, because what is going to happen is it will come down a little bit, create a higher low, then go up again. But I want to sell it at this level so that when it comes back, I pick another trade. So I'll go to sell now. Okay, I'll close the trade as $1. Close based on what the chart gives you and not what you have in your mind. Since the trend was going the direction of my analysis, so there was no need to hedge. You only hedge when the trend reverses. So that is how to trade. I'll take another trade. Probably you see how I hedge. I want to take another trade. This is volatility 10-1s index, and this is the 5 minutes time frame. Okay, looking at this chart, you see here it was a little bit volatile upward trend. Then somewhere here it was consolidating as the market was ranging. It wasn't making any visible upward trend or downward trend. So currently it's making a downward trend, and this looks like a volatile downward trend. Since it's making a downward trend, I'll open a sell. I'm going to open a sell position. So it doesn't keep on going down and it retraces up, no problem. That's when I'll hedge this trade. So either way, I'll still make profit. So I'll go back to the 1 minute time frame to establish my entry. So going back to the 1 minute time frame. So this is the 1 minute time frame. If you look on the 1 minute time frame, it's very clear. It's a downward trend. So I'll go ahead and open a sell position. I'll use the landscape mode. So I'm starting with a lot size of 0.20. That's for volatility 10-1s index. So I'll click the sell button to sell. So the trade is running. Let me go back to the chart to calculate where my take profit should be. Since it's making a lower low, our profit should be on this support level here. So my take profit should be on this support level here, just in case it makes a double bottom and decides to reverse. So I'll come back to this trade once it's time to either close it on profit or hedge the trade. Okay, I'm back to the trade after about 5-10 minutes. So the level I entered the market and it keeps going up. So at this level, I'm gonna hedge it so that once it gets to maybe around this level, it will start giving me profit. So what is gonna happen now is I'm going to hedge this trade. So remember what I said. I started with 0.2 lot size. 0.2 lot size, so I'm going to hedge with 0.6 lot size. But because this is a volatile market, I'll start with 0.4. So I'll first hedge with 0.4. So since I opened the sell position, if I want to hedge, I'm going to open a buy position with a lot size of. So I open a position with a lot size of 0.4 now. So if you look at the chart, this is the level of my sell, and this is the level I just hedged the market. So I open the buy position with a lot size of 0.4. So I'll wait for it to retrace a little bit. Then I open the another buy position with a lot size of 0.2. I'll come back to this trade once it's time to hedge or close it on profit. So I'm back to the trade after like an hour. I didn't hedge the second lot size because the trend did not reverse below where I initially hedged. So I'll go ahead and close this trade. If you look closely, this is the overall profits here showing here. This is the amount we have profit. So from the hedging, this is the amount we got from the hedging. This is $6.48, and the loss is $4.5. But what matters is our profit is more than our loss. That's one thing with hedging. One thing with hedging is that the hedge trade, the profit will surpass the loss and start giving you profit. So I'll close it now. I'll close this trade now. So first I'll close the loss, then second I'll close this on profit. So before we had $51 here, now it's now $53. Thanks for watching. If this video was helpful, don't forget to give it a thumbs up and also subscribe to the channel if you're yet to subscribe. Talk to you on my next video.